I became interested in investing in my teens, but I didn't have anybody to turn to for advice. Like most investors, I made mistakes and learned a few lessons the hard way. These days, there's a wealth of good information available from some of the greats like J.L. Collins, Warren Buffett, Peter Lynch, John Bogle, Benjamin Graham, and many others. Yet despite the abundance of knowledge available to us, many people, including professionals, continue to make the same common mistakes. In this video, I'd like to share my own list of the 20 most important lessons all investors should be mindful of. I'm sure I've missed a few, so please let me know in the comments below about any important lessons I should have included and tell me which of these are your favorites. Okay, so in no particular order, here's my list. Number 1, nobody can predict the future. Some of the worst advice comes from the analysts and their predictions. One study looked at the track record of the stock market experts and their predictions. The data set included over 6,600 forecasts made by 68 different so-called experts over an 8-year period, and their accuracy rate was only 47%. You would have been better off flipping a coin. Jim Cramer had an accuracy rating of 47% in this study, and the former chief U.S. investment strategist at Goldman Sachs was right 35% of the time. Forecasts are simply not helpful. Tune out the noise, have a plan, and stick to it. Ignore all the hype, predictions, and speculation. Number 2, there is no optimal investment strategy or portfolio. Since no one can predict the future, you just need to control what you can control. You can't control the ups and downs or what might happen in the world, but you can control your savings rate, emotions, and the risk you take. The best plan is usually one you'll stick through any volatility. Number 3, the desire to get rich fast is very dangerous. The fear of missing out on some quick, easy profits is powerful, and it can lead to poor decisions. The big money is not in the buying and selling with a short-term mindset. In the words of Eugene Fama, your money is like soap. The more you handle it, the less you will have. Have a plan and stick to it. Don't be a speculator relying on luck. Number 4, day trading is a bad idea, and plenty of scammers are out there trying to sell you their market signals of when to buy and sell. If anyone truly had a system that worked, they would protect it at all costs. Here are some recent statistics. 72% of day traders end the year with a financial loss. That's according to FINRA. And a mere 1% succeed over 5 years. Typically, they face financial losses for 6 months before quitting. And yet, 70% say they had a trading strategy relying on technical analysis. Number 5, talent and intelligence are overrated in investing. Finance attracts brilliant minds, and they love making things complicated. The problem, simple is usually better. Index funds outperform fancy derivatives and leveraged ETFs most of the time, and being overconfident with any investment strategy is your enemy. What truly matters is patience, persistence, and controlling your temperament and emotions. I'll refer to Warren Buffett here with 2 of his quotes. The most important quality for an individual investor is temperament, not intellect. And the stock market is a device for transferring money from the impatient to the patient. Number 6, having the wrong financial advisor can be detrimental. They quite often have incentives to sell various financial products and make investing seem more complicated than it really is. I have seen far too many people get placed into front-loaded mutual funds and other bad products that line the pockets of the advisor at the cost of the investor. That's not to say that there's not a lot of good advisors out there, but it's important to understand how their own incentives affect the advice that they may be giving you. If you do want to speak to an advisor, it's a good idea to make sure they are fiduciary. Number 7, the amount of time in the market beats trying to time the market. There is a great deal of studies out there and research showing that trying to make market decisions where you try and figure out the best time to buy and sell, is a losing proposition. Investors who stay fully invested throughout the market's ups and downs outperform those who try to jump in and out. Number 8, money not invested is always losing value. Some people are afraid of investing in fear of losing money. But if you don't invest, you're guaranteed to lose money due to inflation. Money put to work can compound. I have many examples of this in my videos, but I'll just quote Albert Einstein here. Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. Number 9, most funds underperform the market. If you have watched some of my videos, you know I've covered the research and the SPIVA reports that come out on a regular basis. Over 10-year periods and longer, over 90% of professionally managed mutual funds underperform the market due to the fees and poor decisions. Anyone promising you that they can help you consistently beat the market should be avoided. Buffett, John Bogle, and many other greats who are not trying to sell you a bunch of products agree that individuals would be better off just using low-cost ETFs for the broad market. Number 10, hanging on to the losers, for those of you that try to pick stocks. Telling yourself that you'll hang on until you are back to even is not a sound strategy. What you paid for a stock is irrelevant. It's either a good place to have your money invested right now, or it isn't. Ask yourself if you would buy it today at its current price, or if there would be a better place to put that money to work. Number 11, chasing recent returns often leads to below average performance. Studies like the SPIVA report and other similar research show a pattern called reversion to the mean, where funds that outperformed in one period often underperform in the next. Short-term successes or failures due to luck and market conditions tend to balance out over time. So constantly trying to switch up your funds based on recent performance isn't a reliable strategy for long-term investment success. Number 12, diversification is your friend. Many mistakes are due to emotions caused by volatility in the markets, and diversification reduces volatility and risk. One mistake in this area is when investors have multiple ETFs, but they all have huge overlaps in the stocks that they own. Thus, they're really not getting the diversification intended. Number 13, the market is always forward-looking and trying to predict the future. Prices reflect the collective knowledge of the market roughly 6 months in advance. Any catalyst that you may be relying on has already been typically baked into prices, which leads us to number 14. You are not smarter than the market, and you are certainly not faster than the algorithmic trading where sophisticated computer algorithms can scour all of the breaking news in an instant and make trades based on them. Again, try to tune out all the daily noise and be a long-term investor using low-cost ETFs. 15. Panicking and cashing out in a volatile market is a common mistake. The best thing you can do when everybody else is panicking is nothing at all. I've seen people make smart decisions for years only to lose it all during a market crash. Any decision made with a racing heart is likely one you'll regret. You are invested for the long term, and you can't time the market. What the market is doing in any given year or over a couple years is irrelevant to you, or should be. That may sound simple, but it's not easy. So during those times, try not to be consistently checking your accounts. 16. Fees and taxes really matter. A 1% advisory fee doesn't sound like much, but over a working career, just a 1% fee can drain around 28% of your returns. If you have watched my videos, you know I've made many detailed examples about the effects of fees. Advisors often place you into mutual funds with additional fees, which are not as tax efficient either as ETFs, further dragging down your performance. 17. Higher expected returns come with higher risks. If you seek higher returns, you got to accept higher risks. There's always that trade-off. If someone promises you high returns with little risk, you should be very careful because that should be a huge red flag. Bonds lower volatility, but they underperform stocks over the long term, making them a drag on long-term performance. Remember, there's always a trade-off. 18. Simplicity wins. Complex products come with high hidden fees. Often, these products are sold to the wealthy individuals as an exclusive offering. They are well marketed, but the high hidden fees and handsome sales commissions for the advisor generally make them a poor investment. It's usually best not to mix insurance products with your investments. Keep things simple. 19. Avoid penny stocks. Over-the-counter penny stocks are highly tempting for many beginning investors, but they are extremely risky and an easy target for fraudsters. It's very difficult to get trustworthy recommendations because the market is full of pump and dump schemes and is essentially unregulated. While good estimates are hard to come by, some experts say that around 99% of penny stocks become worthless. 20. Never borrow money to invest in stocks or the commodity markets. While using financing can be advantageous to us when buying other assets like real estate, it's not a good idea for stocks and commodities. It adds additional expenses in the form of interest. It can greatly magnify your losses, and you're subject to margin calls. Plus, it limits your time frame, forcing you to be a short-term speculator. There are plenty of ways to invest without all of these increased risks. Okay, so there's my list of the 20 most important lessons that we all need to keep in mind. Please let me know which ones you would add to the list that I've missed, and which one of these you feel are the most important. Thank you for watching.